The discrete time system is along with the building blocks which we discussed in our previous class. We are set to discuss or understand what is a Black-Scholes-Merton option pricing model. So we'll understand what the model is, its assumptions. We can also derive the Black-Scholes PDE, so something which can be easily done. And because we know the basic principles, right? I mean, we have to just extend those things in order to arrive at that differential equation which you generally see. So we'll do that. Of course, we'll not get up till the entire solution, because if you want that explicit formulas for calls and puts, that is something which takes a lot of effort, which honestly is not required. But at least having an idea as to how to get to the differential equation, that is something which you guys will find useful and handy as well. And at times, those are the kind of questions which can come up on various interviews as well in the future. So maybe they may want you to explain them an approach as to how exactly you reach a Black-Scholes PDE and subsequently how do you solve it. So maybe if it's those kind of roles which you're targeting, I mean, having an idea of the way in which things are to be done, it becomes easy. So we'll talk about that. So actually, that was one of the questions which had come on one of my interviews, I think about 8 years back. So I was applying for one of these investment banks at that time. And as a part of their interview process, they had asked me to solve the Black-Scholes differential equation. So that time I realized that this can be one of the areas which can come up on any interview subsequently as well. So that's why we'll just extend the approach for the binomial one which we have studied. So we'll take the same setup as we did the last time. So if you recollect, the last time we had taken delta number of shares and one option. So we'll stick to the same setup. And then only thing is, rather than talking from a discrete time perspective, we talk from a continuous time perspective. That's the only difference. So naturally, the concepts like etos, etc., which we did not really have to use as a part of binomial, now we are going to have to require. Now we'll be using it. So we'll talk about that as well. But before we go there, getting an idea of what the Black-Scholes model is and the framework, that is something which we'll quickly run through. So allow me to share screen. Okay, so firstly, this is a continuous time model. So again, showing it diagrammatically is going to be a challenge. I don't know how to show it diagrammatically, so we'll not get into that, because a continuous as time system, as you know, always works in the limit, your time step tending to zero. But again, once we have an idea of Black-Scholes, in the next week, we'll talk a bit about numerical methods. So there are ways in which you can solve any differential equation. So we'll try one of them through a simple numerical scheme. So we'll talk about numerical methods in the next week's discussion. But before that, would be a good idea to understand Black-Scholes. So a few assumptions which go into the Black-Scholes model. So just like any other model, Black-Scholes also requires a few assumptions on which this was based. So these were the set of assumptions which was followed a few decades back when the Black-Scholes-Merton model was developed by the three scientists, Black-Scholes and Merton, which led them to winning a Nobel Prize for their accomplishment. So a few assumptions are: the price of the underlying follows a log normal distribution. The underlying was taken as a stock. The risk-free rate was assumed to be known and constant. Volatility was assumed to be flat, that is a constant one. There were no restrictions on borrowing and lending rates, and they were assumed to be equal. So that way, borrowing and lending funds from the market can be done seamlessly at a constant or equal rate. So that was another assumption. In the very first model which they had developed, they had assumed that there were no dividends which were paid on the underlying stock. Naturally, arbitrage opportunities don't exist. So in most of the derivatives theory which you study, no arbitrage opportunities is always one of the basic assumptions which will be done. So we assume that such arbitrage opportunities do not exist, and we are working in that arbitrage-free environment. The markets are assumed to be frictionless. So we'll talk a bit about frictionless or continuous markets once we complete our workings on Black-Scholes. Also, I would like to talk about a few enhancements which the market has applied on top of Black-Scholes. So once we run through our discussion on the BSM model, we'll talk a bit about the enhancements also. And options were assumed to be European in nature. So these were a few assumptions. So yes, a couple of assumptions may not appear very realistic, but those were the ones which were used in the very first model which was developed. Subsequently, market has done a few changes to these assumptions so as to make it more in sync with what is actually happening in the market. So we'll talk about that as well. So those will be the enhancements which the market has done on top of the framework. So you can imagine the basic Black-Scholes model is more of a framework. So when I say a framework, you can imagine this to be like a structure on which, or it's a structure which you can use for pricing options, and you can then change this framework a bit as per your requirements. So for plain vanilla options, Black-Scholes happens to be a model of choice, and that is something which everyone uses as well. But in case one wants to go in for something which is more advanced, they may want to make some enhancements on top of this framework. So we'll talk a bit about enhancements along the way, but you can imagine this is like a framework which can be scaled up or modified as per the requirements. So this is a brief on Black-Scholes model, which is a very popular continuous time model. Now, for the next 20 minutes or so, I'll be staying on the whiteboard and we'll talk a bit about how to work on a Black-Scholes partial differential equation. So the differential equation which you see in the textbook, we can easily arrive at that result as well. So we'll see how that is done. So until then, any questions on this slide? Okay. So let me just switch screen. All right. So your Black-Scholes partial differential equation. Again, for arriving at this differential equation, we'll start off with a certain portfolio, just like we had done for the binomial model. Then we'll try to create the portfolio which is riskless in nature. That is, we want to eliminate any kind of uncertainties which are there in the portfolio. And we take a very, very small time step. So whatever discussions which we are going to do, assume that we are working in a very small time step dt. That is, your dt is tending to 0. So we take a very small time step and we try to model the behavior for this particular asset. Now our asset here is nothing but a stock price because that was uh, because that was something which was used for deriving the Black-Scholes PDE. Subsequently, this was extended for usage in FX as well, something which we call as the Garman-Colligan model. I'm not very sure about the spelling, but Garman-Colligan model. So this is just, again, as I mentioned, you take BSM as a framework and then modify it. So the primary Black-Scholes was for equities. Now, Garman-Colligan was a slight enhancement which was done on equities and you could use it for FX as well. So can you think of one change which would be required for FX? So something which doesn't exist for equities. So think from asset price evolution perspective. So something which you would not find in equities, but something which is there in FX price modeling. So when I say equities, you can think of GBM. So for FX, I want to do something similar, but there would be something additional which I would want to include. So what would that be? Can anyone guess?
So regarding derivative of FX or the underlying security?
Underlying security. So if I had to define an equation, something like ds equal to something dt plus something dw. So if I had to do it for fx, then what would be one small additional thing which I need to include? Okay.
Sir, maybe country risk.
Uh, yes. Could you maybe extend it further? Yes, you are right. Something to do with country risk. Would you like to relate it with a certain quantity?
So real exchange rate.
Correct. So basically, I want R and RF. because if you see, we had only risk-free rate which we're using for equities, but in FX we require the risk-free rate in the foreign currency as well. So we may require R and RF. So R could be the domestic interest rate, RF could be the foreign interest rate. So that's like an enhancement which you do on top of your primary modeling exercise. So something which you do for equities, you can extend it to FX this way. So once we complete Black-Scholes, I'll generally give you an idea of how you can do it for FX also. So we'll briefly cover that. But this is that small change, that inclusion of the foreign risk-free rate. That is something which we don't require for equities, but that we need for FX. And that's precisely what Garman Colligan did as well. So this is something which I can just erase because this was for our discussion. Okay, so coming back to our equity setup, which is the Black-Scholes Merton, I'll like to define my portfolio. So my portfolio would be long position in one option, and I would want a short position in delta number of shares. Something very similar to our earlier setup. And let's say I call this portfolio as pi. I just want to call it, give it some name. So I would like to call my portfolio as pi. And this is nothing but a combination. So let's say I call my option value as V. So let's say V minus delta S. Now I have V, which I'm calling as my option price, and my option has an underlying, isn't it? Because I have the underlying as the stock price, which I would want to have in my analysis. So I would like to slightly tweak this equation so that it looks like V of ST minus delta S. So can anyone guess why I'm writing it in this way? I mean, where I would like to go to after I write this? So can you relate this with our discussion in the previous class? So there's a reason why I have written V of ST. So anything which comes to your mind, something which we have discussed on Wednesday. So some process.
We might use ethos idea
Very
and
good.
use differentials to try and get something out of it. And since we
Absolutely.
have two of them based on S, we can maybe work something out.
Very good. Correct. Yes. So that's precisely the idea. That's why I would like to write it this way so that I can apply Ito's process. Because when we had discussed it generically, I think we had written it as something like G of XT or something, whereby we had that X as the underlying and T was my time and G was this asset whose behavior I was trying to understand. So this is very, very similar to what I've written right now. Now I've made it more explicit here. So I've written V as my option price and S and T, so that I know that my underlying is S and T is the time. So very similar to the earlier discussion. So for Ito's process, we know that we try to have this dependency on underlying asset and time. So just taking a step back, when we talk of an Ito's process, I think we had written it as something like A of xt dt plus B of xt dz or dw. So we had written it as something like this, if I recollect, in our previous class. So this was like a extension from the basic Wiener process, isn't it? Because when we generalize the Wiener process, I did not really worry much about talking about this bracketed term xt. So initially when I wrote the generalized Wiener process, I had written it as a dt plus b dz. So I had taken a and b to be some constants or maybe some variables which I did not have to worry about from dependency on underlying asset and time. But then I wanted to extend this understanding to the underlying asset and time, because finally that is how I can relate it to the derivative which I'm studying, isn't it? So that's why we introduced this xt dependency on these variables. So, and finally that led us to the Ito's lemma result which we did. So that is precisely the same logic which I would like to use here. So I'm writing this as V of st. So that's the reason I've represented this way. I just delete this thing, this is not required. colors as well. So I'll just number the steps so that if you're noting it down, then it will be easier. Now we are going to take, so as I mentioned, we will be working in a very, very small time step. And in that small time step, I would like to make this portfolio risk less in nature. That is, I want to eliminate any kind of riskiness. That is, when I say I'm creating a portfolio which is risk less, I'm essentially saying that that portfolio can earn me a risk-free rate of return, because something which is riskless will earn me a risk-free rate. An example can be a government security. So whenever we are investing in government bonds, all that we receive is the risk-free rate, because it's a simple risk and return calculation, isn't it? If I'm not taking on additional risk, all that I should earn is the risk-free rate of return. So I'm doing the same setup here. I'm trying to eliminate any uncertainties. So when I say I'm eliminating uncertainty, I can say I'm eliminating risk. And whenever I eliminate risk, all that I remain with is the risk-free portfolio, and a risk-free portfolio would earn me a risk-free rate of return. So that's the idea which I like to apply here. So let's work on that. Now our asset S is going to follow the normal stochastic differential equation which we had studied earlier. So S, which is my stock price, follows, and SDE of the form ds equal to RS dt plus sigma S dw. So this is the normal GBM process which I would ask my underlying equity to follow. So this is the same process which we discussed the last time as well. Now in our very, very small time step which we are looking at, we are going to hold delta as constant. So in my small time step dt, we hold delta to be constant. So we'll talk a bit about the significance of this as well when we complete the derivation. So there's a concept which we call as a dynamic delta hedging as well. So we'll talk a bit about that after we derive our result. So something which we'll cover in the latter half of today's class. For now, in this time step, we'll assume that my delta is remaining constant. Now, if I would want to see that how exactly my portfolio value is changing in this time step, then this is where I can say I want to work on something like a d pi. That is, or I want to understand d pi. That is, I would like to say d pi is equal to dv of st. So I'm just keeping this as it is so that it is synonymous, or it looks very, very similar to the way we have written it here. Minus delta is remaining constant, so this will not change, delta into ds. So as a first step, let's work on solving this dv or dv of st. Now other portion is easy, d of s etc. I have to simply plug in the values. So in order to solve this equation, I am going to focus on the first term, and here I am going to apply etos. So doing that, step number 5, I can say dv is equal to delta v by delta t into dt plus delta v by delta s into ds plus 1 by 2 d2v by ds square into ds square plus 1 by 2 d2v by dt square into dt square, and so on. So this is nothing but applying etos. I'll just write it maybe in a separate color here. Now, to solve this, firstly, I know that in a very, very small time step, I don't need to worry about anything which is of a order greater than 1. That is, dt greater than 1 is something which I ignore because my time step is very, very small. So dt square and all the higher order terms are something which I need not worry about. So this will vanish. I cannot cancel out ds square directly because I need to expand ds square and see how it works. So we'll see that in a moment. But for now, we just have to worry about these first 3 terms, 1, 2, and this ds square. Now we'll solve ds square and then we'll plug it in. So is everyone with me up till now?
Yes, sir.
Okay. So is it okay if I erase the top section, say up till step number 2, so that I can continue with step number 6 there? So would it be okay to erase this much portion? So have you guys noted that down?
Yes, sir.
Okay. So step number 6. So let me see how ds square looks. We have a square plus b square plus 2ab. I'm sorry, multiply. Now I'd like to write dw as square root of dt because I know that it is going to change with the scale square root of t. So anyway, dt is my time step. So I like to simplify this. So before I simplify, if I can cancel out something right now, it will be convenient for me. So that way, the first term I can easily cancel out because this is higher order in time. dt square is something which I don't need to worry. Always remember, we will be focusing on dt, which is raised to 1 only. So second order in time, third order in time, don't worry. We have to ignore that because those are very, very small time increments which are not going to impact the result significantly. So from ease of modeling, all these higher order terms we ignore. So this will be sigma square s square square root of dt square plus 2 rs dt plus sigma, sorry, into, my apologies, into sigma s into square root dt. Now, if we see, we have dt raised to 1 and dt raised to half. So that is dt raised to 3 by 2. So again, the second term is something which will vanish. This won't be required because, again, something which is greater than dt raised to 1, I will ignore. So the second term vanishes. And I'll be left with sigma square s square dt. So that way I can say ds square is equal to sigma square s square dt. So now if I go back to my step 5 and if I plug this in, I can just replace ds square by this. So doing that, so plugging ds square into step 5. Or maybe I'll just do 2 steps in a go. So let me also write ds here because I have a ds term here, right? So I have a ds which I can write as rs dt plus sigma s dw. So in this step 7, I'll do 2 things. Firstly, I'll just plug in the value of ds square which I have calculated, and secondly, I'll also write ds as rs dt plus sigma s dw so that I don't have to write the same thing twice. So plugging in ds square into step 5 and writing ds as rs dt plus sigma s dw. Because this is something which we haven't touched up till now, isn't it? This ds. We have only worked on ds square. So let's do these 2 things together so that we don't have to write step again. Step number 8, my dv would look something like dabba v by dabba t into dt plus dabba v by dabba s into the process for stock price, which is rs dt plus sigma s dw plus 1 by 2 d2v by ds square into sigma square s square D2. So I just erase steps 3, 4, and 5 now, because anyways we have written step 5 once again. So that way we have the equation with us. Delete this much. So let me just open up the brackets. Now there's a reason why I want to open up the brackets, because whenever you're working on such equations, you always try to group all the dt terms together and all the dw terms. So I would want dv equal to something into dt plus something into dw. So there's a reason why I'm doing that as well. We'll come to that. So let me just open up the brackets first. So I can say dv is equal to dabba v by dabba t. So let me keep this dt common. Plus, I'll just open up the brackets and move the dt's together. Plus rs dabba v by dabba s plus this last term 1 by 2 sigma square s square. I'm sorry, into d2v by ds square as well. This thing into dt. I'll just take dt common. That's it. Plus sigma s dabba v by dabba s into dw. Okay, so have we taken everything? Okay, looks okay. Fine. So my dt's and dw's have been separated. So that way my dv portion is done. But dv is not my entire portfolio, isn't it? My entire portfolio is d pi. So I have something like a d pi is equal to dv minus delta into ds. So right now we have just written this portion dv. I also need to expand this thing delta into ds so that I have my entire d pi into calculation. So this is taken care of. Now let's add this as well as a part of the calculation. So in step 8, so in the next step, I'll just repeat this thing and I'll add minus delta ds. In the meantime, I'll just erase this much. Okay. So now I can write dv, sorry, d pi is equal to, so I just put a big bracket around this just to avoid any typing effort. This would be as it is, minus delta into rs dt plus sigma s dw. Now let me just expand this because I need to cancel out a few terms or maybe combine them together. So now let me just erase step 6 and do step number 10 there. So everyone with me up till this point, what we have done, I have calculated simply dv, and now I'm going to open up these brackets. So this double quotes which I've written here, this is nothing but the same dv equation which I have written above. So just to save on writing, I haven't repeated this again, but now I will repeat it because I want to open up this bracket and again combine the dt's and dw's which this new delta term is getting in. So that is what I want to do now. So is everyone with me up till this point? Anyone is feeling lost or maybe wondering why exactly we are doing this or how exactly we are doing this? Please feel free to get any
So
raise
just
any
to be
queries that
clear,
you may have.
we are doing all this to calculate the Black-Scholes equation, right?
Yes, yes.
Basically, we are just deriving the equation right now. Correct?
So we are deriving the PD, yes.
Okay, cool.
And
Thank you, sir.
in the next week, we'll solve that PD.
Okay, sure.
Okay. So I'll just delete step 6. Okay. And now writing step 10, just expanding the brackets. So I have a d pi equal to, again, I'll just try to write them together. So I have this delta rs dt, which I can bring together. So I just need to add this new dt term here. So I can write it as dabba v by dabba t plus rs dabba v by dabba s plus 1 by 2. Just a couple of more steps and we are done. Sigma square S square d2v by ds square minus delta r s, and this will be whole bracket into dt plus we have a sigma s dv by ds minus delta into sigma s, and I have a dw common outside. So again, I have two terms. I have something in dt and something in dw. Now, from this, we know now our main aim is to make this portfolio risk-less in nature. So when I say I am making something risk-less in nature, that is I am eliminating uncertainty or I am eliminating randomness from the equation. Now, dt term is fine. dt is the deterministic portion. I don't have to worry about dt. But it is this second term which is causing me problems, because this dw is the portion which introduces the random behavior into my overall setup. Now, this is something which I want to eliminate, because as I mentioned, I want to create a portfolio which is risk less in nature. So in order to do that, I need some way to get rid of this entire dw term. If I can get rid of this dw term, all that I'm left with is this bracket into dt, which is deterministic. There is no randomness here. So that way my riskiness in the portfolio gets eliminated. So let me write this equation, only the dw portion, and see how we can eliminate the randomness. So let me just delete steps 7 and 8. Okay, so to eliminating randomness, I'll write only the dw part, nothing else. So I have a sigma s dabba v by dabba s minus delta into sigma s into dw. Now, there will be one unique value of delta, which if I choose, will make this portfolio riskless in nature. That is, I'll get rid of the dw term. Now, if I choose delta to be equal to dabba v by dabba s, so therefore, by choosing delta equal to dabba v by dabba s, we can eliminate randomness. Why eliminate randomness? Because I'll essentially be cancel out the entire term, isn't it? We can eliminate randomness. Let me plug that in and then we'll see. It's just plain subtraction, but I'll just do it anyway. Delete this section. So if I plug this value in, it's just plain subtraction of two terms minus dabba v by dabba s into sigma s dw, which is equal to 0, because these two terms will cancel out and it will be 0 into dw, so we get a value of 0. So that way, the second term, by this unique choice of delta, is going to help me eliminate dw. And once dw has been eliminated, I am happy, because randomness in my equation has vanished. And once that has vanished, I can say that I have created a portfolio which is risk-less in nature. And something which is risk-less in nature, I know it is going to earn me only the risk-free rate, because I have moved completely into the deterministic space. So now my dpi will have only the first part. So just for simplicity, I'll just write this once again, or maybe I will write it in the end when I equate this to the risk-free rate. So that way, we'll only have to worry about the first term now. Only this much exists, and this thing has vanished, has gone away. Only this thing remains. Now, let's say R is the risk-free rate, which I'm looking at. Then can I say that over a very, very small time step dt, my portfolio value can change by this much quantum? So can I say d pi equal to R pi into dt? So over a very, very small time step, my portfolio will earn me a risk-free rate of return, which is small r. So I can say over time dt, my change in d pi can be R pi dt. So let's say I call this as equation 1 and I call this as equation 2. Now I can equate them together, isn't it? Because the left-hand sides are the same. I have d pi here and I have a d pi here as well. And logically, they also tally, because whenever I have created a portfolio which is riskless in nature, I want to show that my portfolio value will only increase by the quantum of the risk-free rate, which is small r. So that's why I say d pi equal to r pi dt. So I can safely equate 1 and 2 together because they have the same left-hand side. So equating 10 and 12, I have this large dt term, and maybe I can just change this a bit. So can I write this equation 2 as r into v minus delta s into dt? And this delta is the same dv by ds which I have written here. So maybe to further simplify this, I can also write this as r into v minus dv by ds into s into dt. So I've just expanded this. I just plugged in the value of pi and I've written this together so that I can plug this value in and equate them together. So I'll do that now. So just rewriting the above term plus 1 by 2 sigma square s square d2v by ds square minus, I can change this delta as dv by ds. So I have rs dv by ds, and this will be equal to this thing which we have written. So I just multiply this inwards. So we have rv minus rs dv by ds into dt. Now dt's are going to cancel out anyway, but for convenience, let me just write dt and then we'll cancel them out here. So we have a common term dt on the outside. Here also we have a common term dt on the outside. So I can just cancel out dt's because they are common. Also, I would like to cancel out this because I have a minus rs dv by ds, and here also it's minus rs dv by ds. So if I move this term to the left hand side or this term to the right, either ways, these last two terms are going to vanish. So now I have my equation almost. So if I just delete step 11, I'll just write this once again for the final time. So we have dabba v by dabba t plus rs dabba v by dabba s plus 1 by 2 sigma square s square d2v by ds square minus rv equal to 0. And this is your Black-Scholes-Merton partial differential equation. So this is the equation which you see in textbooks, and this is one of the ways to derive that equation. So that way we have arrived at the exact same result which was derived by Black-Scholes-Merton as a part of their analysis. Later on we'll see how to solve this equation as well. Now luckily for this equation we have a closed form solution. So when I say a closed form solution, you have a ready formula. So if so once we go back to the presentation, we'll talk about that. But so yes, I mean, here we have a ready solution for a call and put price, but that may not be the case all the time, because many times you will be presented with a certain equation for which there is no ready solution. So whenever a ready solution does not exist, some kind of a numerical technique will have to be used. So in our next week's class, when we talk of numerical techniques, we'll talk of simulations and finite differencing schemes, which we can apply to solve these kind of equations. So we'll talk about that in the next class, but there's an approach to solve this. So although this looks very complex, it's not a very complicated equation to solve numerically. So when I say numerically, it's more of an numerical approximation which we try to do. Because something which we solve analytically, we can't say that we have an exact solution. We can say that we have a solution, but it's a close enough approximation to the exact solution. So that's why we always call it as a numerical approximation. So we try to derive it in the best way we can, or the most optimal solution. So that is something which we'll do in the next class. How do you convert this differential equation into a difference equation? That is something which we'll talk along the way. But this is your Black-Scholes PDE. So any questions up till now? So yes, I mean, I had to eliminate a few, I had to delete a few steps because the whiteboard length is not sufficient, but we have gone through the entire process. So any questions in this?
So the last part you just said that there can be some times where we have to do some numerical thing, and this is some put or call. I did not understand that part.
Correct. So basically, if now this is your partial differential equation or the Black-Scholes-Merton PDE. Now, if you open up a textbook, you'll also find a formula for a call and a put option. So you'll have a ready formula, call equal to something and put equal to something. So to get from Black-Scholes to these formulas, again, there is a lot of computation which has to be done. So I think roughly 5 to 6 pages of calculations are done for moving from this PD into calls and puts. So this ready formulas, something like an call and put, is what we call as a closed form solution. That way you have a ready-made formula which you can use. But these are very rare scenarios whereby such ready formulas are available. In most of the cases, you will be presented with a differential equation and you will be expected to solve that differential equation. So that is the time when you can use numerical techniques. And numerical techniques is something which we'll cover in the next week.
Okay, sir.
So now you guys know how to solve the PDE. So if on an interview this question comes up, then you can confidently do that. Honestly, it's very, very similar to what we have done for the binomial variety. We have created a riskless portfolio and we have simply equated that with the risk-free rate of return. That's it. Otherwise, even if you do it yourself once, you'll be very comfortable with that. It's not complicated at all. You may be seeing these for the first time, so yes, it will look a bit complex, but to be honest, it's not very difficult. So don't worry much. Okay,
Sir, I had
yes,
one question.
yes.
Sir, can you suggest any reading material for mathematical understanding from basic level, like for those of us who are not very well versed with the mathematics? So, can you please provide us with any educational material or so?
John Hull is pretty decent actually. So because Hull explains things from the basic. Now, if you ask pure mathematics, then there are many textbooks on pure math. But pure math, I'm not sure if it will be appealing for everyone. Because those who may be coming from a math background, yes, they will find it very appealing. But for others, it can get boring. So I would say that rather than focusing on the core math or pure math perspective, I would suggest that try to relate it from an application perspective so that it makes things interesting. Like now, here we have applied mathematics. I mean, we know the math part and we have applied it to achieve some purpose. Now, if you just solve it if you just solve it for the math, I mean, for the sake of mathematics, it may not be that interesting for everyone. So my advice will be maybe start going through the financial theory. Wherever you require math, you can go back and explore that much and then come back to your application. So I would say that study math from an application perspective rather than spending too much time from a pure math perspective.
Okay, sir. Thank you.
So let me just,
Also, sir, one more question.
yes,
Sir, I understood that when we calculated delta is equals to del V by del S
correct,
to eliminate the riskiness. That means that when we select delta to be that, then riskiness is eliminated.
correct.
Such a similar explanation. What could be a such a similar explanation for the Black-Scholes equation? Like what we are trying to do with that equation.
So even in the so before we derived the Black-Scholes differential equation, our first aim was to eliminate riskiness in the portfolio. That is, we want to create a portfolio which is riskless in nature. So that was the main aim. And if you see delta equal to dabba V by dabba S, that is nothing but the same definition for delta of an option. So now what we have done is we have eliminated the delta risk which is there in my portfolio. So if that actual, so you can imagine that as the option Greek, which we are talking about. So that's the same delta or similar delta which we had studied in the earlier discussion as well. So if you recollect, let me just switch back. So if you recollect in our earlier discussion, I think for the binomial variety, we had delta equal to something like option price at the top node minus the bottom node upon, I think it was something like S0U minus S0D or something like this. And here we have delta equal to dabba V by dabba S. So even there, if you see, we had eliminated randomness by creating a portfolio which was riskless in nature, and we can create a portfolio which is riskless whenever we can get rid of the delta risk which is embedded. So in this case, by choosing delta equal to dv by ds. Now this is also a technical definition for a Greek or option uh, Greek as we call it. Now, by choosing this value of delta in this very, very small time step, what we have done is we have eliminated uncertainty. Now, this is the term which was also contributing to that uncertainty portion, because delta, as we know, is a very dynamic parameter that keeps on changing. But in our discussion, we have taken delta to be constant in this very, very finite time step dt. In dt tending to 0, my delta is not changing. So in this time step, I decide to choose this value of delta so that I can get rid of the dw term. So you can imagine that in this very, very small time step, my portfolio has become riskless in nature. So finally, that has helped me reach my final goal of eliminating riskiness in the portfolio. That is, I'm creating a portfolio which is risk-free in nature. And that's why I decided to choose this value of delta.
Okay, sir.
So that way, actually, these are two related concepts, I would say, something which you study on option Greeks and something which you apply for Black-Scholes. So that's the exact same definition for the Greeks delta, which we study. So in the next slide, we'll talk a bit about delta hedging. So at that time, you will be able to have further clarity on what happens whenever you go in for a static versus a dynamic delta hedging. So we'll talk about that as well. So switching back to the presentation. Okay, so a derivation of Black-Scholes through these principles. Now, this is like a closed form solution. Now, when you have such formula C equal to something and P equal to something, these are what you call as a closed form solution. Very, very few instances whereby you have such closed form solutions available. Now, this is just like a textbook thing which
Sir?
you'll observe. Yes.
Can we just take a 1 minute break?
Sure. Actually, what you can do is maybe we can continue for 5 more minutes and take a 5 minute break if that's okay.
Okay, so that works, sir.
Yeah. So this is like a normal textbook formula which you'll get. So you can use it directly, but every time such a ready formula may not be available. So at that time, numerical methods are used. So how to solve a Black-Scholes-Merton equation numerically is something which we'll be discussing subsequently. Again, this is just a simple snapshot I've taken off the internet. I mean, this is like a standard formula. All right. So maybe now we could take a break so that later on we can talk a bit about complete markets and enhancements which get applied on top of Black-Scholes. So maybe let's take a 5 minute break. So I think it's around 12:30 my time. So let's take a 5 minute break and come back by 12:35. Would that be okay?
Yes, sir.
Okay. Okay. Hi guys, can we resume? Is everyone back?
Yes, sir.
So next is idea of complete markets. So when we talk of black shoals, so this was one of the assumptions which we had used for deriving the model. So when I say complete markets, that implies that trading in the markets can happen seamlessly. That is, buying and selling of assets, be it the underlying asset or the derivative, that can be done seamlessly without any segmentation. That is, a complete market is something whereby you don't really have discontinuities in the market, something where you can continuously transact or you can trade. So that is what we call as complete markets. So this was one of the building blocks for black shoals. So the assumption of complete markets was there. So if you see the assumption, like there are no restrictions on borrowing and lending, etc. Now this is also one of the facets of having a complete market. So something, whenever you have that kind of a market, such kind of operations can be done very easily. So there is a concept which we call as delta hedging. So we had chosen a value of delta to be dV by ds as a part of our calculation. So this is technically also what we call as the definition of delta, which is nothing but the change in the option price for a given change in the underlying price or the underlying stock price. This is also what we call as the option Greek delta. So we have, so in our setup, we had taken a very small time step in the limit dt tending to 0. And in this small time step, we had chosen a value of delta to be dv by ds. And this had resulted in our portfolio becoming riskless in nature. Because by choosing this value of portfolio or choosing this value of delta, we were successful in eliminating the dw term, which was introducing randomness. So this had vanished. That is, my portfolio became riskless in the time step dt by choosing a value of delta to be equal to dv by ds. So this is what I had done. So that made my portfolio riskless in this time step. So now if I want to do continuous delta hedging, that is, let's say I have done this as dt1. Now if I go to dt2 and if I have to repeat this same process of creating the portfolio riskless, is that possible? Similarly, if I go to dt3, which is the next time step, can I make the portfolio riskless once again? So now my question would be, firstly, is this possible? So can I create a portfolio which is riskless at different time instances? So my dt1 is taken care of. So can I do something similar in dt2 and dt3? So this is my question one. And second question is, from a practical perspective or from a practical trading perspective, would it make sense to continuously delta hedge a portfolio? So would anyone like to attempt any or both of these questions? Yeah, someone raised the hand. I think. Yeah, please go ahead. Yeah, I think Mihir and Neil have raised their hands. Yeah, please go ahead.
Sir, I won't speak in mathematical term. I'll speak in very logical terms if it's okay.
Yes,
So
absolutely.
I'll answer the second part first. So it
Mhm.
is possible to continuously delta hedge theoretically, but the cost associated with it will be high in the long run. For example, we are continuously paying premium for options, so this may eat into our P&L. So that is the
Correct.
major factor. And how long will it continue depends on your risk appetite. Like on
Okay.
what time horizon do you expect the portfolio to mature or to liquidate then? And answering first question, it is possible to delta hedge at various times. It is active portfolio management, but it needs to be done dynamically considering the volatility of the underlying security. For example, if you're invested in highly volatile security, which may be susceptible to downward price pressure, so
Mhm.
you need to short sell it.
Okay. Correct.
Or
Yes.
conversely, you can go long.
Correct.
So
Good.
it is possible, but it has to be done very actively, proactively, and secondly, it is costly. To the answer to the second question.
Correct. Good. Yes. Yeah. I think one. I think Neil also had raised his hand. So if he wants to answer, I mean, Neil,
Yes,
you can
sir.
go.
Similar answer.
Okay. Okay. Correct. Yes. So good. So I mean, both are correct responses. So yes, I mean, theoretically, you can definitely delta hedge at all times. So I mean, at different time steps, you can delta hedge in theory, because in theory, you are not really investing any money, isn't it? So that is not really impacting your final portfolio profitability, because since there's no hard cash involved, there's no P&L calculation which we are really worried about. But from a practical perspective, that may not be possible all the time, because, as you rightly said, every time we transact, there is a certain transaction cost and related operational expenses as well, which have to be borne. So whenever that happens, there is all that starts uh, hitting the overall portfolio profitability, because whenever we calculate the overall P&L or the profit for the portfolio, we need to deduct any kind of costs which are there in the trading activity. So if we try to delta hedge at all times, then that beats the purpose, because that way it is going to be a very expensive thing to do. So practically, no one would want to delta hedge at all possible times. However, that being said, there are certain approaches which fund managers frequently use. So something which is very popular among NBFCs as well. So especially those who offer products like index-linked debentures, etc. So they generally try to delta hedge a part of their book at the end of the trading day. So, or maybe they may want to hedge the entire book at the end of the day. So generally, what they do is during the last session of a certain trading day, so the last half an hour to 45 minutes of trading business, they would want to delta hedge a certain section of the portfolio. So they will say that this much portion of the portfolio is very, very risky. So we would want to delta hedge it at the end of the day. So, by doing that, during the last half an hour, they may take certain trading actions so that they can eliminate delta for that much portfolio or that much section of the portfolio. So this can be like business as usual. So every day in the last trading hour, this can be a strategy which is applied. Otherwise, what they could do is in volatile times, that is, whenever there is significant amount of volatility in the market, portfolio managers might want to delta hedge at more frequent intervals. So let's say the market starts at 9:15 and there is a lot of volatility. So a fund manager might want to delta hedge a certain portion of the risky portfolio, let's say at 11 o'clock. So they may do it at 11 once. But imagine that the volatility still continues or it still rises further. Then the fund manager may say, let's again delta hedge a section of the portfolio around 1 o'clock. So that way, there may be more number of instances during the day in these kind of extraordinary times whenever a fund manager might want to delta hedge. But normally, in a business as usual scenario, and the delta hedging activity generally is done during the last trading hour. And in extraordinary times, it depends upon what risk appetite the fund manager has, and generally how much is the volatility which you observe in the market. So that's how generally you look at delta hedging from a continuous perspective. Now, talking of a couple of enhancements applied to the model parameters. Now, a few things which we have seen in the black shows that may not appear very realistic. So, market has applied a few enhancements on top of this. So, a few things which are done is time dependency of interest rates. That is, rather than having a constant value of R, we would switch to R of small t. So this is what we call as time dependent interest rate. So so can you guess how much should be this time dependency? Now, for what tenor of rate should I be fetching the value of R? Because I need some value for small t. So what should be this t I should be looking at? Anyone? Okay. So I look at the time to maturity for my option. So this small t, I try to equate with the time to maturity. So let's say I enter into the option, let's say I've entered into it 1 month back, and let's say it has total 3 months to expire. So standing today, so I had entered into the option on day zero, and my total time to maturity is 3 months. So let's say I'm standing on the 1 month time point right now. I'm on this cross section. So t star 1 equal to 1m. So standing here, if I want time dependency, I will look at the risk-free rate for a period of 2 months and I'll plug it into the calculation. Now, let's say I move ahead in time and I reach a cross section of T2 star. Let's say I am at the 2 month time point. Then now I may want to look at R for 1 month only because my time to maturity is 1 month. So this is what you call as time dependency. So that way you look at how much you have time to maturity for your option, and accordingly we use that in the calculation. So again, here you may require some bit of interpolation techniques which are to be used. So we'll talk about that a bit, or maybe we could talk about that now as well, because interpolation is something which you require for volatility as well. So we'll quickly talk about volatility and then we'll spend some time on interpolation. So I can do something similar for walls as well. So rather than having a flat wall, I may want to have a time dependent wall. So something like a sigma t. So using a similar analogy, I look at my time to maturity for the option, and accordingly I pick up the value for sigma and I use it in my consumption. And that way that sigma gets used in the calculation. Now, again, before we go to the dividend adjustment, maybe talking a bit on interpolation. So have you guys studied or done interpolation in the past? So has this been covered in your other subjects?
No, sir.
Okay, but or maybe any of you may have used interpolation on, let's say, any of your assignments or maybe projects in the past. So maybe the first question could be, what could be interpolation? Then we'll see approaches. Okay. So whenever we are interpolating something, what we are trying to do is we are trying to arrive at a certain intermediate value between 2 points. So let's say I have an interest rate curve. So let's say I have tenor and yields. So let's say this is 1 month. I have, let's say, 1%, and let's say I have 5 months, which is, let's say, 4%. And my aim is now, let's say these are the only 2 points which are available to me. So if I go to Bloomberg, let's say this is the snapshot which I have taken from Bloomberg, and these are the only two time points at which yields are being quoted. But my requirement could be, I want to know what the yield is at the 4 month point. So this is something which the market is not quoting, because maybe the 4 month point might not be liquid enough. So market doesn't really quote the value for 4 months. So this is a scenario whereby I may want to use interpolation. So I leverage the data which I have. So I have 1 month and 5 month data, and from that I try to arrive or try to estimate what could be the yield for the 4 month time point. And this is what we call as interpolation. So is this idea okay? Okay. Now there are a couple of approaches to interpolation as well. So in so there is a ready formula in Excel. So you can use an Excel user defined function, something which we call as a linear interpolation. Or even the higher order ones are spline interpolation.
So do we use Lagrange? Lagrange?
Lagrange multipliers, yes, you can, but generally for most of your applications, these two are good enough actually.
Okay.
Now, at least, I mean, for normal industrial applications, one of these is generally used, and I would say spline is slightly more flexible as compared to linear one. So again, you can do a simple formulation. I mean, the formula for linear interpolation is easy, so you can actually solve it by hand. You can do it manually as well, or you can use an Excel function as well. So I think Excel has a forecast function, which will readily give you a value for interpolation. So that way, if you look at, if you imagine this is your input, 1M, 5M, and these are the two rates, and you want to figure out this question mark. So your inputs could be the known data, that is 1 month and 1%, 5 month and 4%, and you plug in this 4 month point, which is a target tenor, and then you try to solve for this question mark. So that is also what you call as a linear interpolation. That is, you look at 1% and 4%, and you try and estimate the best fit value for this 4 month point, and that will give you the yields for 4 months. So this can be accomplished through a simple forecast function. You can do that through a normal formula for linear interpolation. It's easy. Now again, when you say linear interpolation, that implies that you're trying to fit a straight line. So given these two data points, you're trying to fit a straight line between them. So if I have this thing as 1 month, 1%, and I have 5 months as 4%, let's say. And let's say this is the cross section which I'm looking at, the 4M cross section. So what I do is imagine these are the 2 points which are my 1M and 5M. So I'll try to fit a straight line between them, and I'll say that this cross which I have shown here is the rate for 4 months. So this is my cross section for 4 months, and this is the rate. So the question mark which I've written, that is something which I try to find through this. So this is what we call as a linear interpolation. So is this something which you might have used in the past anywhere? So it may happen that you might have used this, but you may not be familiar with the terminology of linear interpolation. So have you had a chance to use this in the past?
Sir, it is used to find the yield of bonds, non-tradable bonds.
Correct, absolutely. That's one of the applications, yes.
And also for internal rate of return.
So actually,
Big
for
one.
IRR, it's a separate calculation actually, because for IRR, basically you try to equate your inflows and outflows together, and then you try to find the best fit value. Now, interpolation doesn't really worry about whether you have an inflow or outflow. You simply give them two extreme data points and you try to find out something in between. So that is all that interpolation does for us. So that way, IRR, etc., is a more comprehensive concept. This is comparatively simpler. And have you guys also had a chance to maybe, so I mean, in the yield analysis also, I mean, along with linear, you do something which is better, which we call as spline analysis. So anything which might have been covered in your fixed income class. So this is linear interpolation. There is a spline as well, spline interpolation. So spline can be either a quadratic or cubic or any higher order, etc. Okay. So again, could anyone guess what could be the advantage of using a quadratic or maybe a cubic over linear? So what's the advantage over of these things over a simple linear function? So what benefit do I get by using these slightly advanced models as compared to linear one?
So you can. Hello, sir.
Yes, please go ahead.
Yes, you basically can get more flexibility in terms of the curve, and you don't have to stick to a linear movement.
Correct. Very good. Yes. So whenever you switch from linear to something which is of a higher order, something like a quadratic, the advantage is it gives you the benefit of handling any kind of change in the shape of the yield curve or any kind of curvatures in the yield curve. So whenever you talk of, let's say, something like a quadratic relationship, you could have something like maybe y equal to ax square plus bx plus c. This can be an example of a quadratic relationship. So why quadratic? Because now you have an x square term, isn't it? Your simple linear equation could look like something like y equal to mx plus c or y equal to ax plus b, whichever you like. But here, if you see, you have x raised to 1. This is the only power of x which is available for our consumption. And because of this, this is a linear operator because it understands only a straight line measure. It doesn't understand any curvatures. Now, whenever I go in for something which is of a higher order, something like a quadratic or maybe even cubic. So a cubic could be even more flexible, something like ax cube plus bx square plus so on. So that way, these higher order terms will help me include any kind of flexibility in the model. That is, whenever my yield curve has changed shape, the yield curve changes may not be parallel all the time. If there's a change in the shape or the nature of the yield curve, that is something which might have to be handled. And that is something which your linear interpolation will not understand because linear interpolation is a straight line operator. Any kind of changes in the actual underlying nature of the rates is something which linear will not capture. But a cubic spline or maybe even a quadratic spline, because of the higher order terms which are there, it will be able to understand the curvature in the relationship. So that is the reason why people would want to use spline interpolations in certain cases. So does that sound okay? Okay. Of course, I mean, R will also have a few libraries around doing this interpolation thing, but maybe in Python we can quickly do something on interpolation. So in Python you have a SciPy library, which you call a scientific Python. So SciPy supports a lot of interpolation activities as well. So maybe we can quickly do some simple interpolations so that you know how that is done as well. Linear interpolation is easy. You can do it in Excel, but splines in Excel is a bit of a problem. So it's slightly painful to do it in Excel. So generally we don't do that in Excel, but otherwise these advanced scripting tools and these interpolations can be done very, very easily. Yeah. Yeah. So is interpolation okay? Does anyone have any questions? Because this is a concept which you'll have to use elsewhere as well, not just in this subject, but many a times you may not have the required data. So at that time, interpolation might be used. So any questions on the idea of interpolation? Okay. So just a related concept, there is something which we call as extrapolation as well. So what could be extrapolation? We have discussed interpolation, but could you guess what could extrapolation be? Let's say I'll just write a one snapshot of the yield curve. Let's say I'll stick to the same yield curve. So let's say that 1 month and 5 month are the only two yield points which the market quotes. Imagine nothing else is available after this. So 1M and 5M, this is the only snapshot available. And for my purpose, I want to know what is the yield for the 6 month point. So that is my requirement. Now, this is something which the market doesn't show because the market says that we are quoting yields only up till 5 months. Beyond 5 months, we don't quote anything. So at that time, I may want to figure out what is the 6 month yield. So this is where extrapolation can be used. That is, I use the available data which is given to me. And based on this, I try to extrapolate a number for 6 months. So now extrapolation is a slightly risky operator to use. So something which has to be used with caution. Because the thing is, for extrapolation, you don't really have a bound as to what up till which your rates can go. Because if you contrast this with interpolation, in interpolation, if you see, I was calculating the rate for 4 months, and I had two terminal points which were given to me. One was 1M and other was 5M. So between these, I had to figure out this rate for 4 months. But for extrapolation, that is not the case. I just have this 1M and 5M data given to me, and I need to extrapolate. So that way, there is no boundary for as a reference which I can use for my modeling purpose. So that way, extrapolation is something which one needs to be very, very careful about when they use. So maybe some additional testing might be required, or maybe number of sample points should be increased before extrapolating data. Otherwise, I mean, extrapolated numbers may not be very reliable. So, so to be honest, up till now, I mean, I have never used extrapolation in. So even if there is a certain instance whereby I need to use a certain longer tenor point, what the market generally does is we use the longest available tenor for our consumption. So let's say that 5M is the maximum tenor for some curve which I'm using. And I have certain cash flow which happens at 6 months. So naturally, I would want to know what is the rate for 6 months because let's say I want to discount that cash flow. So let's say I have a cash flow which is coming in at 6 months, and I want to know the PV of my cash flow. So for PV purpose, I would naturally have to know what this question mark is or what this rate for 6 months is because without that, I can't have the discount factor. So one way to do that is extrapolation naturally, but something what the industry prefers is they use the longest available quoted tenor. So here we know the quoted tenor is 5 months, and for this tenor we have 4% as a rate which is given. So we will use 4% as a rate for 6 months also. That is because this is a quoted rate. And whenever we use that rate in the calculation, we can safely say that we have used the longest available tenor in the calculation. And in my report, I'll clearly mention that although we have a cash flow which is coming in at a point which is farther than 5 months, which is the maximum tenor up to which the market quotes values, we are using the 4% rate, which is equivalent to 5 months, because that is a market quoted rate. And we are not using interpolation, but we are using the longest available tenor rate for our consumption. And that is something which you can use in their calculation. So that is another acceptable approach. So whenever such a scenario comes up, wherever you have to decide between extrapolation or something else, then this other approach is something which is much more stable, something which the market prefers as well. If you have to use extrapolation, no one will say no, but you have to use it with caution and care for the points which I just mentioned. So as long as you can justify your methodology, you're good. I mean, so that way there is no specific guideline which says that you have to use extrapolation or the other approach which I mentioned. But the second approach is something which is much more popular. So any questions for anyone? Okay. Now coming to another adjustment or enhancement which is applied to model parameters, adjustments for dividend payments. So if you see in the earlier assumptions for Black-Scholes, it was assumed that no dividends were paid on the underlying stock. But that has been tweaked a bit. So the basic framework still works on the assumption that no dividends are paid, but now the model has been modified a bit so that you can adjust for such intermediate dividend payments on the stocks also. So again, these are small tweaks which the market has done on top of the Black-Scholes framework. Now, measures of volatility. So now this is something which we'll talk about in our discussion on volatility. So anyways, we'll be talking a few things on vols. So at that time, we'll spend some time talking of the ways in which we arrive at volatility and how exactly a vol is to be used. So request you to hold on to this volatility point till then. We'll talk about this in one of our subsequent classes. Now let's say you're trying to develop or maybe validate a certain model in a system. Then can you think of the steps which are generally followed? So what could be the approach which I should take? So imagine that I have to validate a Black-Scholes-Merton model. So can you think of 3 or 4 steps which I need to do to ensure that I'm validating that model correctly? Validating, reviewing, whichever you like. Anyone, any steps which you can think of? So I'll give you an idea. Any model. So I'll give you a hint so that you can try and respond. So for every model you have an input. You have the actual processing or calculations, and the output. So these are the 3 things which you do for any model. So based on this idea, would you like to guess any steps which one should follow either for developing or validating, not just BSM, but any model, I would say? So imagine that you're a consultant and a bank has given you a project saying that we have a certain model, we want you to validate that. But we want you to validate that in entirety. So what all things would you like to check before you can give a sign off to the bank?
Sir, I'm not sure, but will we use train test or a confusion matrix?
So yes, that is a part of your calculation. Yes, that can be one. Yes. Anything else? So maybe that could be testing of your methodology. Correct.
Sir, I think first of all, we need to check what are all the assumptions that we are going to make.
Correct. Very good. Anything prior to the assumptions also?
Our objective.
Okay. And something which is related to achieving the objective? So try to relate this with the 3 points which I
Making a
mentioned.
hypothesis.
So a hypothesis we can try to combine with the objective as well. So maybe we
Yes,
can
sir.
say,
So
but
the data time series data.
absolutely. Thank you very much. Input data or market data, precisely, because your model is only as good as the quality of your market data. If your market data is trash, then the model output is also trash. Very good. So market data, clarity in objectives or hypothesis, model assumptions, methodology, correct. Anything else? So you guys have covered the first 2 points almost. Anything which you would like to comment on the output also? Can I say MIS or management information system? Because you may have a model which is calculating a correct output, but if the model is actually reporting some random number but not the actual output, that's a problem, isn't it? Because finally your management or regulators are going to consume the MIS report which is being generated. If the MIS report is fetching some wrong number and presenting it in the report, then that's a problem. So again, that is another thing which has to be checked. So good, all valid points. So I've listed something similar here as well. So source of relevant market data, very, very important, because if your market data is stale and if it is not up to date, then that can impact your final analysis or final results. So having an updated market data is important. So if you're using Bloomberg or Reuters, ensure that you have updated Bloomberg tickers or Reuters RICs, which are mapped into your system. So generally the thing is you have something like a BBG or Reuters. And this is something which will go into your enterprise risk system, maybe something like a Calypso or a Murex. So this is your primary source of market data. So all of the market variables, things like interest rates, FX rates, equity prices, commodity prices, etc. All of these things will go in as a part of your market data, which you can source from Bloomberg or Reuters. Most of the banks have both of these sources. They can choose one, or maybe they may be having one and use it as a primary source. Just ensure that whatever data points you have mapped in Bloomberg, they are up to date or they are correct, because these data points are something which your system is going to use to fetch the data. So if your data points are mapped incorrectly, naturally your system will fetch all the incorrect data. So that is something which is simply not acceptable. So as a part of your validation, you would want to test whether this mapping is correct and whether the market data which is flowing is fresh and it is up-to-date data. So that is something which is step number one. Next is having clarity on your objectives, definitely. So maybe after this, I can have this objectives point as well. So good. I mean, I have missed that, but I'll include that when I circulate this presentation. So having a clear idea on the objective which you are trying to accomplish, that is, let's say I want to build a risk model, a risk measurement model, or maybe I want to have a Black-Scholes model, or maybe I want to have a stress testing model, etc. Now, all of these objectives have to be clearly defined so that we know where exactly we are going at. Next comes your methodology or approach. So this will also include your assumptions, because every model is based on a certain set of assumptions. So even Black-Scholes has a certain set of assumptions. Similarly, you have other models also. So having clarity on what methodology you want to apply and what assumptions to follow, that has to be there, because finally all of these things are going to determine how good the model is going to perform as well. So that way, and deciding this, and if it is validation, then testing this methodology or approach and assumptions is important. Many a times it can happen that a modeler might want to use some convenient assumptions to reduce their modeling effort. But if that is having a detrimental effort on model performance, then a model validator should point out that a certain XYZ assumption is not acceptable. We want you to change it because that is impacting the model performance. Then comes the actual model development. So once you have frozen on the market data, your approach and methodology has been finalized, then comes the actual model building. So this is also what you call as developing a model. So you can either have a model which you can configure in an enterprise risk system, something like Calypso or Murex, or maybe you can customize your model in Python, R, or any other tool. Or third, maybe you can source your model from a certain third party and use it for your consumption. So there are various ways in which your model can be configured and used. Next is benchmarking of results. So this is actually a step before MIS. So after this, you have the MIS bit. So why benchmarking is important? Because if you're building a certain model, you would want to know whether that model is giving a value which is close enough to expectations. So many times what banks could do is there are a couple of ways to address this. So let's say I have an enterprise risk system. Imagine I've purchased Calypso and my Calypso valuation is coming out to be V1. Then I build my customized model for validation. Let's say this gives me a value of V2. Now I compare V1 and V2, they are closely in sync. So that way I have one degree of comfort that fine, this is good enough. But I may want further comfort on the valuation number. So I may use the Bloomberg model to arrive at a value V3 as well. And I would like to compare whether V3 is close to V1 and V2. If this is close enough, then yes, I'll be happy that my model validation has happened correctly. So not only is my model giving a value which is close enough to what the business is consuming, which is Calypso, but at the same time, it is also in sync with what something like a Bloomberg does as well. So that gives me additional comfort. Other than this, other approach could be having counterparty valuations also. So what I could do is I could request my counterparty saying that uh, I have such and such a product, and of course now I will have entered into a contract with them. So I may request them to submit their valuation number. So let's say my counterparty gives me a value of V4. So that way I have another number to compare. So as long as these four numbers are in sync with each other, I can safely say that fine, my model is behaving decent enough. So either you could use a Bloomberg or wherever possible, you can ask for counterparty valuations as well. And that is something which you can use for benchmarking purpose. So benchmarking gives you an added level of comfort that the approach and methodology which you have applied is correct and that is in sync with what the market does. Then comes MIS. As I mentioned, MIS is your management information system. So this could either be internal or it could be, so when I say internal, it's for your internal management or it could be regulatory as well. So be it any of either of these two, it's important that your MIS reports are correct because if those reports are incorrect, your top management will have a wrong picture of what is happening on the ground. Because your top management doesn't do the things day in, day out. They'll simply consume the MIS reports and then use it for other decision-making purposes. So at that time, I mean, having a proper MIS report is important. You have to ensure that all of the data points which are mapped, they are fetching the correct numbers. If you're reporting incorrect numbers, that gives the incorrect picture about the overall setup. So that is something which needs to be checked as well. So generally, these are a few steps which one needs to take care whether they are either developing or validating any model. So maybe not just Black-Scholes, but for any model, I would say. So any question on the approach? Because many of you may either join developing or validation in a few months when you join your respective firms. Okay. So anyone joining any of these big four firms in their development or validation desks? So I think Deloitte is a big recruiter for Gokhale. So I think Deloitte USI comes on campus if I recollect correctly. So anything on development or validation which is offered to the current batch? Okay. Look, if not now, at a later point in time, definitely. I mean, these can be opportunities which you can definitely explore. So I think this is an interesting area to work and something which you should definitely check out. Just the last portion now. Again, Black-Scholes is an immensely popular model and it's used by everyone, starting from front office, risk, middle office, as well as the back office bits in both banks and financial institutions. It can be used for constructing wall smiles or wall surfaces. So we'll talk a bit about wall smiles and surface later on. We'll not spend too much time on wall surface, but in one of our subsequent sessions, we'll talk of wall smiles. So at that time, I'll tell you how exactly Black-Scholes comes handy for the construction of a wall smile. So for now, I request you to hold on to this point. We'll talk about this in a bit. It's well understood by market participants because this model has been around for a very long time. So everyone is familiar with this approach. Then this is an acceptable model whenever it comes to any kind of reporting activities, be it financial or regulatory reporting. Then Black-Scholes is Another model which companies, precisely banks, use for meeting various regulatory requirements. So things like capital charge, exposure monitoring, CVA adjustments, etc. Everywhere, Black-Scholes pricing is considered as an accepted methodology. So that is another place where Black-Scholes option pricing model gets used. And of course, more advanced models are based on this framework. So as I mentioned, you have one framework and then you build on top of it. So you have a base set of assumptions and methodology, and then you keep on enhancing on top of it. So there's a reason as to why this is done. Uh, because thing is something which has been around for a very long time, something like a Black-Scholes framework. That is a robust framework which the market accepts, and market believes that this is a correct way of pricing the model, pricing an option. So what the market will do is, rather than scrapping the setup which is so stable, they use the existing setup and then they apply enhancements on top of it. Because developing something from scratch takes a lot of time, and then it takes time for its stability to build, also at the same time for the market to accept it. But something which has already been developed and market has accepted, then it's easier to build on top of this. So as we say, rather than reinventing the wheel, we use something which is already there and then build something on top of it so that enhancements are there. So that's how Black-Scholes framework gets consumed by the broader market. So these are a few applications and I would say a few advantages of the Black-Scholes model as well. So now in the next class, when we meet, we'll talk a bit about numerical techniques. So two things on options which you do. Maybe one of the days next week, we'll talk a bit about a few trading strategies which we use in options. And we'll talk a bit on numerical methods as well. So once we talk numerical methods, we do some hands-on also so that we know how exactly a numerical technique can be implemented in a certain system. So that is something which we'll target for the next week. So we'll stop at this point today. So this was the thing which I had planned for today's discussion. I wanted to give you an idea of Black-Scholes and how exactly that's used by the market as well. So any questions on today's discussion?
Sir, is there any reference material to for this other than your PPTs?
Yes. So again, John Hull.
Okay, thank you, sir.
All right. So let me quickly take the attendance so that we can close for today. So I think my IB sheet is open. So maybe we can start with international business first. Ayush Sharma, present. Yeah, Ayush Sharma is present. Alisha Gupta. Vidhi. Anant Jain. Anish Dopeshwarkar. Anjali Sethi.
Present, sir.
Arshada Imam.
Present, sir.
Barkha Israni. Bhavya Patel. Saloni Bhujbal. Petra Tirodkar. Devam Pandey.
Present, sir.
Diksha Karna. Gauraja Nevatia.
Present, sir.
Gayatri Narkhede. Govind Mittal. Sawan Hake.
Present, sir.
Himanshi Verma.
Sir, it's Himanshu Irmani. Present, sir.
Sorry. My apologies. Yeah. Indu. Ishita Saxena. Kanika Goyal. Kartik Mittal. Asro L. Akshay Singhal. Mahi Rajawat. Mansi Gupta. Pathangi Warrior. Megha Parak. Nancy Halawat. Neha Jain. Pratishtha Pradhan, Rohan Bagai, Rohit Poddar, Samida Malik, Shivangi Semwal, Simran Pahuja is present.
Present, sir.
Srishti Verma, Tanu Goyal, Tarang Kadyan, Kalyani Todkari, Twinkle Karnawat, Vaishnavi Shrotriya, Vanishka Jain, Vibhor is present. Vidushi Rana,
Present, sir.
Yash Mehra. Yeah, so the IB class is done. IB class can leave if you guys have another session after this. I'll just quickly take the attendance for financial economics, and we'll again be meeting on Monday at the usual time. So starting with financial economics, Akash Jain.
Sir, Ash Singh, present, sir.
Mistake. I mean, there was a Singh and Jain bond below. My apologies. I've been using Excel since morning, so it's a bit of mix-up. My apologies. Achal Jain,
Present, sir.
Ayush Bhushan,
Present, sir.
Adesha Hati, Tejas Akware, Ali is present. Anjali Garg, Anmol Sen,
Present, sir.
Arishpita Deka, Avni Mishra, Ayushi Rohtagi,
Present, sir.
Sarvesh Bagal,
Present, sir.
okay, yeah. Bhavya Dang, Cherry Chhabra,
Present, sir.
Diksha Chauhan, Janta Singh,
Present, sir. Dipansha.
yes, yes. Gaurav Kadam,
Present, sir.
Gaurav Datir,
Present, sir.
Himanshi Verma, Jaideep Saini,
Present, sir.
K. Ayushi, Riya Shukla,
Present, sir.
Kriti Marwa,
Present, sir.
Mansi Singhal,
Present, sir.
Man Simran Arora,
Present, sir.
Manvi Kukreja is present, Mihir is present, Muskan Garg, Namrata Gaur is present, Neil is present, Nikhil Agarwal,
Present, sir.
Prasool Sharma,
Present, sir. Present, sir.
yeah, Pratik Maheshwari,
Present, sir.
Rachit Tyagi,
Present, sir.
Rahul Ghosh,
Present, sir.
Rahul Giri, Rahul Goswami,
Present, sir.
Raja Tirth is present, Rashi Jain is present, Rishabh Kothari,
Present, sir.
Ruma Keshri,
Present, sir.
Sahaj Manocha, Sameksha Chopra, Sharanya is present, Shubham Jain,
Present, sir.
Shubham Kumar,
Yes, sir.
Someshwar Verma,
Present, sir.
Stuti Mehrotra, Anika Thakur,
Present, sir.
and Vinaya Pawar. All right, yeah. Thanks, guys. Thanks for joining in today. And again, we'll take our discussion ahead on Monday. We'll talk a bit of some more things specific to options, both trading strategies and numerical techniques, and we try to do some hands-on as well in the next week. So have a good weekend ahead, and I look forward to meeting you on Monday.
Thank you, sir.
Thank you.
Thank you, sir.
Do
Thank
we
you,
have
sir.
any live market session of option trading, sir? Because it will like give us some good practical knowledge, sir. Because
Yes,
theory
sir.
is something on the different side, but
Correct.
to be
Correct.
on a practical, that is more important.
Correct. Correct. So we'll talk about that. So maybe, I mean, once we cover our, I mean, whatever has been there in the syllabus, we'll complete that, and maybe towards the end we can quickly discuss that as well.
Yes, sir. At least for 30 minutes or 40 minutes, that will be more enough for us, sir.
All right.
Okay.
We do that. Yeah. Correct. Thank you, and bye bye.